Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent action has, more or less, been captured within the two explosive days range back in late February, between 1579 and 1759. Since then, despite an initial but now defunct bull channel, we've seen the market edge lower in a two steps up, three steps down action, such that last week saw a test and breach of the support band 1579 to 1571, and prices briefly tested down to the 1560 level. This recent two steps up and three steps down action has left the door open for the late February to date action to possibly be a descending triangle pattern. A few things first before I go any further. This possible descending triangle is by no means a perfect example of such a pattern, but there are significant elements there that does make the action such a possibility. Next, we actually have two possible descending triangles within each other in the offing. One from late February until 2 weeks ago, last week being a false break lower, and one from late February until today, including the drop last week as part of the pattern. Finally, a bit of information about descending triangles. Firstly, descending triangles can break in either direction, acting as a topping action as well as a continuation action. This one in question seems to favour a possible upward continuation action. Indeed, those descending triangles that see a market rising in beforehand have something like a 6 or 7 times out of 10 chance of breaking higher. Thus, an initial primary potential target X on the top side for the smaller descending triangle pattern will be in the 1757 area, right where the 50% projected Fibonacci line resides. A fuller secondary target X1 for this pattern would be in the 1810 area. Now, looking at the larger pattern, an initial target X2 would be in the 1780 area, with a secondary target X3 in the 1844 area. Now, this ties in with something I've already spoken about 5 weeks ago and repeated since. I spoke then about 3 simultaneous patterns we'd seen over the middle and end of last year and going into this year. They are all bullish. They are a rounded bottom, large cup with handle pattern, and a scallop pattern. Now, the rounded bottom still has a primary target on the top side in the 1983 area, which is up off the top of my daily chart. The next one is the large cup with handle pattern, which has a primary target in the 1910 area. Once again, this is off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern. This has a primary target in the 1836 area, again off the top of my daily chart, and interestingly, the one I have the least confidence in, even if it is the nearest. These are all, well, as I've previously said there, way out there, but as we have seen aplenty in recent times, lots of things that are way out there can suddenly happen. I would like to finish off once again on something that I said in my annual review of soybeans made at the very start of 2022. Back then, I was only looking at long-term charts, and I said these words, and I quote, "One other thing I would like to, let's say, provisionally float by you. It is way early on this, but it should be worth considering, is look at the whole of the 2020 to date action as a possible bullish halfway hesitation. In which case we might, I say might with due deference here, we might have a possible target X topside in the 2025 area." I will just repeat that, in the 2025 area. This is way, way up off the top of my long-term chart, and it might sound ridiculous now. Indeed, it does sound ridiculous, but it is what I see, and I'd rather say it and maybe look ludicrous and even laughable now than be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month and likely a multi-year potential target X, so there ought to be plenty of time. Plus, it will depend on what the market does when and if it meets the 2021 high at 1667, and as we've seen, we've already done that, and the 2012 high at 1789, which we still haven't done. That's the end of the quote. This bigger picture idea done at the beginning of 2022 is still there. Chicago soybean meal. The key feature here for now many weeks is no more and will be retired after today. I'm of course referring to the broken October to November 2021 bullish Andrews pitchfork. 2 weeks ago, the market broke down for a final time down through the lower time, currently at 492.90. However, a solution for what was going to come next is clearer but not transparent. We have, as I've previously said 2 weeks ago, the potential for the late January to date action being one of two patterns. The first is a possible bullish halfway hesitation. Now, the market has some form on this, as it had constructed some bullish halfway hesitations, most recently in mid-October 2021 to early February 2022 move. So I know it would be yet another bullish halfway hesitation I'm talking about. I know. But if it ain't broke, don't fix it, and the recent spate of bullish halfway hesitations have certainly not been broken. Thus, I've placed a provisional target X1 in the 520 area, just off the top of my daily chart, just in case this actually turns out to be true. The second possibility is to look at the same action as a possible topping action of some form. I'm not wholly sold with this idea, not yet anyway, but I thought it worth mentioning. See, there's a possibility for a double or triple top, but I fear not for a head and shoulders top, as the neckline would need to be a French curve to be one. The one key feature in recent days that might influence which of these two the market chooses has been the rising short medium moving average, currently at 456.5. This has been acting as a proxy for an uptrend with no two consecutive closes below it. Thus, this is the key nearby support that any attempt lower would need to break, and the key nearby support that could start a move higher. However, it is worth remembering that right now these two patterns are still just potential patterns at this time. Chicago soybean oil. Of all the Chicago soybean complex, the landscape of Chicago soybean oil and this daily chart has changed by far the most. Initially, after the change gap in March, the market worked its way higher, filling in the gap left 3 weeks ago. However, the previous all-time high back in 2008 at 72.67 managed to temper, if not halt, the rise on two consecutive closing occasions. Indeed, the June 2008 high at 68.97, another relic of those days, stopped the subsequent fall. Thus, it was those 2008 levels that have captured the recent market until Friday of last week, when the market managed to punch up through the 2008 based overhead resistance and up to levels seen back in early March. Now, last time I put forward that there is an argument for the late February to date action being a possible head and shoulders top, looking on a continuous chart. I had drawn a neckline, currently at 68.24, but I did not label it as I found it awkward. Given what has happened since, I'm more inclined to view the action from late February to date as a possible double top in formation, or a head and shoulders continuation pattern, or, what is my current favourite, a bullish halfway hesitation. The double top and halfway hesitation are obviously all in construction. The reason for this is that we still have had, as pointed out last time, the lagging indicator of three golden crosses over February and March, which have influenced this market. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.